Well, markets are reacting to the latest U.S. jobs data, which showed an uptick in jobs for the month. Let's get more now from Chuck Lieberman, co-founders and chief investment officer at Advisors Capital Management. Chuck, thanks very much for joining us. What kind of an impact do you think the numbers are going to have that we're seeing today?
Well, they're going to be difficult to interpret because they are very, very messy. There was an uptick in November, as you said, and a big downtick in October, entirely due to federal jobs. These were all layoffs that the government announced some time ago, and they finally showed up in the data. 162,000 decline in federal jobs. So it dominates the report, and it distorts it. Excluding those jobs, a three-month average has gone from 55,000 last month to 75,000 this month. So the underlying trend is actually pretty positive. And then there are lots of other messy numbers in the report. For example, the Hispanic workforce is up almost 200,000 over the last couple of months. So there's no visible impact of the change in the border policy, which is more than odd. And that accounts for much of the rise in the unemployment rate from 4.4 to 4.6. My guess is that when the government goes back and revises the population estimates and labor force estimates, which they have indicated they haven't done yet, but will do in the coming future, when they do that, I suspect we're going to see the unemployment rate back down. And then the rest of the report was somewhat promising in a sense. The average hours worked was up 1/10 of an hour. That's good. Average weekly earnings was up only 1/10% in November and 4/10 in October. So that's a sizable increase. But year over year, only about 3.5%, 3.5. And that's a slight moderation, which is very promising for those on the Fed who would like to lower rates some more.
Any concerns over, I saw a couple of the other numbers. I saw seasonal hiring, peak seasonal hiring was weak. Teen unemployment, UER was up, and also the U6 unemployment up. How do they factor in then?
Well, the seasonal stuff is supposed to be seasonally adjusted. And there are always ebbs and flows around that. And again, my sense of the numbers is that if you get away from that federal job cut, it's otherwise reasonably good. Part of what's happening, of course, is that immigration across the southern border has stopped. So the truth of the matter is there are fewer workers to be hired. We're even sending some people back. So that should reduce the labor force, and yet hiring continues. And I suspect as the data washes through and we start getting more accurate reads, that's what we're going to see. And then on the wages, which is critical for inflation, if that is really moderating, and I'm not sure I would be firm in my conclusion that it is, but if that's right, that'll provide very good ammunition for those who want to lower rates at the Fed, because they can point superficially to weak job growth and slightly less wage inflation. That'll make their case.
And so how do the markets react to all this? Do we have to wait for it to kind of flatten out, or not flatten out, but kind of get a little more regular, and then they might react a little more?
Well, I think the markets haven't figured it all out, and it takes a while to sift through the data and try to figure out which numbers are accurate and which ones are, shall we say, less than fully accurate. And the market's trying to figure that out. Superficially, looking at the data overall, taking it as given, it looks soft. But I don't think that's really the case. But the market's reacting to that as it normally would be expected to. And it'll take a while for both the market and the Fed to figure out what's really going on.
And you mentioned, I want to come back to the Mag 7 in a minute, but you mentioned about Fed rate cuts possibly. How will this unfold with the bond market, do you see?
Well, I think the bond market is sort of schizophrenic. On the one hand, if the Fed cuts rates, that means lower short-term rates, and that has a downward pull on long-term rates. But at the same time, the market is also concerned about inflation. And if the Fed is easing monetary policy inappropriately, then that means more inflation down the road. and that hurts the long end of the bond market. So the bond market is wrestling with that and oscillating in a random kind of fashion. I don't think the long-term investors have a great grasp as of yet of what the prognosis is for inflation longer term.
And what are you thinking? Just sit and wait with that? What are you doing with that?
Yeah, I think the Fed is going to wait. I think people who dig through the data are going to figure out that it isn't as weak as it appears to be. And therefore, the only way to really get a better grasp is to get more data. And I think that's what much of the Fed will want to do. So I suspect they will not be so quick to push rates down, even though there's a lot of political pressure on them to do that.
And just one last question before we go. I want to ask about your S&P 493.
Yeah, well, the S&P 493 is very reasonably valued. It's the Mag 7 that's very expensive, and that is fully debatable. It's clear that those 7 companies are growing very, very rapidly, and they deserve to trade at a high PE multiple. It's the 493 that's kind of ignored, kind of out of the news, not we're very well focused on, and those companies are doing fine. Corporate profits are growing nicely. The economy continues to do okay, in my judgment. So I think there's real value in the 493, and with the 7, I think you have to debate each one of them because they're all really different firms, and some of them are doing very well. So I think many of them justify those high PE multiples, and I would not blame the 493 as being overvalued because some of the 7 might be.
All right, so lots of homework over the holidays as we head into 2026. Chuck, thanks very much for joining us.
Thank you.
Chuck Lieberman is co-founder and chief investment officer at Advisors Capital Management.